Hey, if you're looking to create a set of financial projections for a nail salon for potential investors or lenders, then you have come to the right place because we have built a financial projection spreadsheet template that is built specifically for nail salons. I'm going to walk you through how to fill it out and kind of what you get at the end and how it's really should be the perfect fit for what a potential investor or potential lender is looking for when they ask you to send your financial projections to them. And I'm going to walk you through this step by step. If you stick around to the end of the video, as a thank you for sticking around, we're going to give you access to a discount code so you can get a discount on this particular template. You'll also be able to go ahead and grab this template with a link in the description of the video below. So you can grab the template, follow along, and work through this for your particular nail salon with me. Before I dive in and show you everything about the template, just a little bit of background. My name is Adam Huxema. I'm the co-founder of ProjectionHub. And over the last decade, we've helped thousands of entrepreneurs create financial projections for all sorts of different industries. And this particular template is for our nail salon businesses. My background is actually in SBA lending. So I was a SBA lender for about 10 years and made a lot of small business loans to various types of businesses. And that's what really inspired me to create ProjectionHub to help those clients that are looking to raise capital from investors and lenders to be able to create financial projections in an easy and simple way. And so we built out all of these industry-specific templates, over 100 different specific templates, and have a video that kind of walks you through how to fill these things out. So that's what we're here to do. I'm going to go ahead and now walk you through this particular template. All right, so this is kind of the end of the process. So once you've entered in all of your assumptions, you're going to come to this At a Glance tab, and you'll see some nice graphs and charts that you could pull into a pitch deck or in a business plan to provide to a lender. You'll also be able to see a 5-year income statement summary, a 5-year cash flow summary, a 5-year balance sheet. And then you'll also see the income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. So oftentimes your lenders may ask you for monthly projections for the first couple of years and then annual projections after that. They may only need the monthly level detail for the first couple of years, but we give you that detail all the way through for the full 5 years in case you might need that. All right, so that's kind of the end of the process. Now, in order to produce these reports, though, we have a little bit of work to do. So we're going to come back to the Input Assumptions tab here. Now, the first thing you need to know here is that every cell that's highlighted in light blue is an assumption that you can change without breaking something in the template. So we've got our projection start month here of January 1st. And we are going to assume that we're going to put in $50,000 of our own money into the business. And so we put month 1 because we wanted to say that this investment is going to come in at the beginning of the business year. So month 1 of the model. We have an assumption that 100% of your receivables or your sales are paid upon delivery. So at a nail salon, you're gonna provide the service and get paid right away. You're not gonna provide a service and then say, pay me next month. No, you're going to collect 100% upfront. So that's why we have that assumption set that way. On the accounts payable side, so this is when do you pay your bills? So we're assuming that you're going to pay 80% of your bills in the month that you incur the expense. And then maybe some percentage of those bills will be on a 1-month delay. So for example, your utility bill, maybe you get an electric bill and you have 30 days to pay it. So you can pay on some sort of delay. So that's why we have those assumptions set that way. On the inventory side, we assume you're going to start out the business here with $1,000 in initial inventory, and then that you're going to hold some percentage of your sales as inventory each month. So this basically, by saying 25%, that just means we're going to keep some amount of inventory on hand all the time. I'm actually going to lower that probably to 10% because we're probably not going to need a whole lot of inventory to be on hand. So all right, we then have the ability to add in fixed assets. So in this example, let's say you are renting a space and you needed to make some improvements to the space. So let's say we made $20,000 worth of improvements or renovations, and we put a life expectancy of 10 years. Basically, the life expectancy is a lot of times going to be tied to the lease for renovations. So if the lease is a 10-year lease, you could make your renovations life expectancy in years to be the same term as your lease. Salvage cost, this just means how much can you sell the fixed asset to at the end of its useful life. We're just going to assume 0, that for all of these assets that you're not going to resell these. If you do, it's going to be for very minimal. And then we select what month we made the purchase. So again, we're assuming this is a startup, and so we're going to assume month 0 for to just represent the beginning of the model. The beginning of the projections is when we're doing the renovations, buying the equipment, buying the furniture, and the signage. All right, now we're also going to assume that we're going to get an SBA loan of $100,000 in month 1, again at the beginning of the model, at an 8% interest rate, paid over 10 years or 120 months. So when you come down to this section, you're going to see this green table, and it's going to say how much cash do I need, and we're going to need to come back to this after we have filled everything out. We're going to want to come back to this and check it again. So right now, based on the assumptions that we have in the model, it says right here that starting cash is sufficient. We have enough cash to be able to cover all of our costs for these startup expenses and to have enough working capital. So the model is going to calculate how much working capital you need, or basically just how much extra cash you need to cover expenses while you build up to a break even. And so the model is saying that's going to take you 11 months based on the numbers that we have in there, 11 months to reach cash flow positive after you open. And so during that time, you're going to need the $62,000 to help cover those expenses as you build up to a break even. Again, after you make changes to the model, you're going to want to come back here and take a look at this and just make sure that this still says starting cash is sufficient. All right, so now let's look at our revenue tab here. So for the revenue tab, we're going to assume that we have an advertising budget to help us acquire new customers. And maybe we're sending out mailers, maybe we're doing Facebook ads, maybe we're doing Google advertising, but we're doing some sort of advertising here for $2,000 a month. And we're estimating that the cost to attract one new client is $50. So let's say you're doing a Facebook ad and it costs you 50 cents of Facebook ads for every click, every time somebody clicks your ad. Well, if it takes 100 people to click your ad for you to get one new customer to come into your store, then your cost to attract one new customer, 50 cents times 100 is $50. So that, you're going to kind of come up with your own assumptions here based on how you plan to advertise and what you expect to happen. And this is going to vary from business to business and where you're located and all those things, but we have kind of a set a default at $50 for the cost to attract one new client. So that then $2,000 divided by 50 gives us 40 new customers from paid advertising. Now we're also assuming you're going to have some new clients from organic sources, so word of mouth or people searching for you or people just walking by and seeing your new store and coming in, right? And so we are going to assume that we're going to, by month 3, have 100 new word of mouth customers a month. And then I'm actually going to show you something here. So this shows you this annual growth rate that is applied to this number. So it's saying after month 3, we're going to grow this number of clients from organic sources by 5% a year. I'm actually going to make this a negative 10%. And the reason why is because a lot of times in a business, you're going to kind of hit a saturation point where, all the customers that are likely to come to your store have tried it at least once and either are going to become regulars or they're not. And so over time, it's likely to get harder and harder to get new word of mouth customers actually. And so that's why I often make this actually a negative percentage so that over time, this number goes down. So this helps us calculate the new clients per month here. And then what we're going to assume is that some percentage of those regulars or some percentage of those new clients become regulars. So we're saying 50% of those new clients now become regular visiting clients. And then we have one more assumption here, our annual churn rate in regular clients. So we're saying that 10% of the regular clients are going to leave each year. Maybe they move away, they end up going to a different salon, or they can't afford it anymore, whatever it might be, but 10% of your regulars end up leaving. So based on all those assumptions, we then calculate our total number of regular clients here each month. From there, we can set some assumptions around client visits. So what's the average number of visits per regular client per month? And we put in 0.75, which means the average client visits 9 times per year. We have an assumption here of the maximum daily client visits for the entire business. So we set this at 55. So let's say you have 6 stations at your salon, 6 stations, and you think that you could have 10 customer visits per station per day. So that would be 60, right? If you had 6 stations times 10 visits, that'd be 60 a day. Let's just say we're going to be a little bit conservative here and say 55 is the maximum daily client visits. And then we're going to say days open per week is 7, 52 weeks a year. So then this will calculate the maximum number of client visits we can have based on, how many booths we have, how many slots we have open, and how many we can see in a day. This calculates how many we can see per month. From there, we say, okay, the maximum client visits is 1668. So this will then estimate our number of client visits per month. And you can see once that hits 1668 here, it just flatlines and it stays at 1668. It stays at that maximum. You've hit your capacity there for customers. All right, so once you've done that, now we need to estimate or put in assumptions around the services and what the costs of those services would be. So we're going to say, okay, we had these 60 clients come in for a visit in month 1. 50% of them wanted a manicure, 40% a pedicure, 15% nail art, and so on, right? So the different services you have available, you have the average revenue per service. So this is what you'd be charging. So you can adjust these to your local market and your price points. These are going to vary. These price points are going to vary a lot. So, make sure to make adjustments based on your specific location and plans. And then the length of service in hours. So this is how long do you think it's going to take you to provide the service? And this is important so that we can make sure that you have capacity to be able to provide these services. You also have the ability to put in a commission for your employees. So if you want to, let's say you want to give your employees a commission. Let me just take a look here. So let's just say we're going to give all of our employees a 5% commission on all services. So we'll enter that in. And then this is where you can put in the average cost of the supplies that would be used during the service. So if you have, specific supplies used in the process of providing the service, you can enter those costs there. All right, from there, we have the employee base pay section. Now, here we're going to say, what's the average number of hours per employee per week? We're saying 40 hours. And that we need a minimum of 2 employees on staff at all times. So that's what we're setting, is that we want to always make sure we have at least 2 employees on staff for all of our open hours. Well, what this calculation is going to do right down here is it's going to say, what's the minimum number of employees needed based on sales, based on these assumptions. So we've got assumptions about how many customer visits we are going to have, how long it's going to take to provide these different services. So based on all of those assumptions, this line right here is going to say, okay, well, you actually only need, in the first month, you only need 1/3 of an employee. And then as you continue to grow, now you need 2 employees. And now you need, 4 employees to be able to meet the demand for those services. So this is automatically going to calculate how many employees you need based on your sales. And then you can enter in an employee rate here of $15 an hour we've got. And then this will calculate the wages, the employee wages that are required. So what it's going to do is it's going to say, okay, well, we need at least 2 employees at all times. And so it will assume that you have 2 employees paid $15 an hour until this number gets above 2. Now, once it gets above 2, this calculated number takes over, and then it just continues to increase the employee wages here based on the calculated required number of employees to provide the services that you're going to offer. So a little complicated there, but what it does is it allows your staffing, your labor, to scale with you as you grow. You're not going to have 8 employees there just sitting around if you don't have the sales yet, right? That's kind of the idea. And so you want to let the model help grow with the growth of your business. Now you can also put in product sales. So you can say 50% of our customers are going to also buy some product from us. Maybe that's a little too high. Maybe it's going to be 10%. 10% are going to buy a product from us. Here's the different products that they're going to buy, price points, costs, and so on. And then based on that, we'll calculate our service and product sales. All right, now on to our operating expenses. So we have the ability to put in different operating expenses here, and you can put the expenses in as either a fixed dollar amount. So there's a drop-down box right here. You can put the expense in as a fixed dollar amount or as a percentage of revenue. So a fixed amount would be, we're going to pay $400 for an accountant every month to do our bookkeeping and accounting. But a percent of revenue expense might be credit card processing fees. So that is that's going to scale as a percentage of your revenue. So if we say 0.02, that represents 2% of your total revenue will go towards credit card processing fees. You can put in things like rent, utilities, and so on. All right, we're also going to put in a receptionist that we're going to have as well, and with an annual salary starting in month 1, ending in month 60 at the end of the model. And you can put in any other salaried employees that you might have here as well. Now you don't want to double count employees, right? So you don't want to put employees in here that are already accounted for through this employee base rate here, right? So this tab is really only for salaried employees that are not providing the service to the client. All right, and so once you've done that, you're back to where you started here, and you see the graphs and charts and tables that are here for you. Now let's come back and just look at that original table here and just make sure, okay, the starting cash sufficient. It says we need 139,000 based on our assumptions, and we have 50,000 from our own personal investment and 100,000 from a loan. So yes, starting cash is sufficient in this model. So that is the process here. If you have questions along the way, please don't hesitate to reach out to us at support@ProjectionHub.com. We'll be happy to answer questions over email or record videos like this to try to answer your questions. And as a thank you for watching to the very end here, we did put a link in the description of the video below to a form. You can fill out that form and you're going to get a discount code, our most up-to-date discount code that will work to take a discount on this particular template. So we appreciate you sticking around to the end. If you have any questions at all, please don't hesitate to reach out. Thanks.